Hello there. I'm Windermere's chief economist, Matthew Gardner, and welcome to this week's episode of Mondays with Matthew. Now, some of you may know that I've just returned from a week kayaking in Yellowstone Lake, Wyoming. And while I was on the water, I got to thinking about some of the amazing data sets that I get to use in my day-to-day business. Anyway, one day while I was paddling and contemplating, I was reminded of a little-known report that's published by the Federal Reserve Bank of New York. And it's one that, at least in my opinion, really doesn't get the attention it deserves. And it's called the US Household Debt and Credit Report. Now, before you all tune out, give me a few seconds, because the second quarter report came out last week, and it really does provide some fascinating insights, not only into our own finances, but it also offers some great data on housing finance. So hang in there. I honestly think you'll find it to be pretty interesting. Okay, let's start out with a quick question. Have you ever wondered exactly how much money we, as households in America, actually owe? Well, if you're interested, I'm going to tell you. We owe approximately $14.3 trillion. A pretty big number. And to give you some kind of perspective as to how big this number actually is, if you take America's annual GDP, the value of all the goods and services that are traded in the country in 1 year, well, that's roughly $20 trillion. But that's not really important. Suffice to say, it is a really, really big number. So when we look at the latest debt numbers, there are a couple of things that stick out. One, we saw a drop in the amount that we owe, roughly $34 billion between the first and the second quarter. Now, this is interesting because it's not only the first drop we've seen since the middle of 2014, but it's also the largest drop since 2013. Now, what's going on here? Well, we can totally blame COVID-19 for the drop. Now, that said, it might sound great in terms of reducing our debt, but our total debt levels are still $1.6 trillion higher than we saw back the previous peak in 2008. So, who do we owe all this money to? Well, when we break the debt down into its component parts, you'll see that, unsurprisingly, most of our debt is tied up in our mortgages. And that accounts for just shy of 70% of total debt, and we owe roughly $9.8 trillion. Now, this is followed by student loan debt, $1.54 trillion. Yep, that's right, over $1.5 trillion in educational expenses. Anyway, then we have car loans, $1.3 trillion, credit cards come in around $820 billion, revolving lines of credit, $380 billion, and finally miscellaneous, and that's $400 billion. Now, the miscellaneous grouping, well, that includes department store cards, gas cards, and those kinds of things. So the real takeaway here is that we saw a pretty sharp drop in our credit card balances, $76 billion. And this is interesting because it represents the largest drop on record, again, a consequence of COVID-19. And from a headline perspective, non-housing related credit balances, well, they saw the largest drop in the history of the report. Now, this may not bode well when it comes to the speed of our economic recovery. You see, if we're not spending, well, the economy can't grow. Okay, we get that we owe a lot of money, but there is more than that. Remember I mentioned earlier that this report also gives some great insights on housing? Well, let's start off with some data on mortgages and credit quality. To be more precise, the amount of money borrowed it's for mortgages by credit or by FICO scores. Of course, this is a very big topic of interest in the brokerage community, and here's a chart on this. Now, I know there's a lot of lines, but there are actually two I want to focus on. First off, take a look at this. From a low of around 22% back in 2006, and other than the period where the government was offering the first-time buyer tax credit, we have seen the share of the mortgage market for those with stellar credit rise consistently. And it stood at a remarkable 64% of total mortgage debt issued in the second quarter of this year. Clearly, most consumers remain highly qualified to buy homes, even in the current, shall we say, unique economic environment. This is good. But on the other end of the spectrum, consumers with less than perfect credit who, as you can see, were certainly players in the market back in the pre-bubble days, well, they're now a remarkably small component of new mortgage debt, and their share has been trending down even further over the course of the last 18 months. So credit quality is good, and I don't see any reason that this will change anytime soon. Now let's look at who is borrowing money to buy homes. Although this doesn't look like a very interesting chart, it reinforces what I have been harping on about for a very long time now, and that is the prevalence of younger home buyers. Look at the red bars. Now these are borrowers aged between 30 and 39. That's right, the older millennials and the very youngest Gen Xers. They are out in force. This is even more proof that they're buying homes. Again, and I really cannot emphasize this enough, millennials are already a major force in the US home buying market, and they'll only get bigger over the course of the next several years. If you're a broker, you're not working with first-time buyers with millennials, you probably want to think about it. So now we've taken a look at debt levels, and we've also looked at mortgage originations. So let's take a look at delinquency rates. Now they are naturally very significant, and they're significant because they have major implications both directly and indirectly when it comes to housing and the broader economy. Now in general, there are no big surprises here. As of the end of June, roughly 3.6% of all outstanding debt was in some stage of delinquency. But that is a 1% drop from the end of 2019. And from a dollar perspective, it's roughly $512 billion. But I do want to expand on a few of the numbers. The first, student loans. Important because of the millennial generation of would-be home buyers that I've been talking about. Now you can see here that the delinquency rate pretty stable for the past decade. But do you see that significant drop in the last quarter? Well, that was totally due not to students or people now working and paying their debt down. It was due to the fact that a majority of outstanding federal student loans, well, they are covered by CARES Act administrative forbearances. But although this looks great on paper, in reality, if we take out forbearance, well, the delinquency rate is a lot higher than this. And I would argue it's something that's actually keeping some younger home buyers sidelined. But you know what? I'm going to leave that topic for another day and another video. Now, the second data set I want to touch on are, of course, mortgage delinquency rates. Now, here you'll see that the delinquency rate dropped precipitously between 2010 and 2016. Again, no big surprises there. Flatlined in the high 3% range until last quarter, when you'll see that it dropped further. Why is this? Well, again, we can attribute this to the uptake in forbearance. And I started digging into some other numbers, and according to my friends over at Atom Data Solutions, there were just 17,000 new foreclosure starts in the second quarter. And that's down from 81,000 in the first quarter. Why? Well, homeowners with federally backed mortgages, well, they were protected from foreclosure through a moratorium that was contained within the CARES Act. So there you have it, the latest data on household debt and credit. Now, my view is that the numbers didn't offer any great surprises, and certainly nothing at all that any of you in the housing industry should be worried about. But that said, the overall drop in non-housing related credit, well, that's very much worthwhile keeping an eye on, because it does have, as I mentioned earlier, the potential to slow down our post-COVID economic recovery. I really hope that today's topic has been at least of some interest to you. As always, if you've got any thoughts about this particular subject, or if you have a question you'd like me to cover in a future video, I would love to hear from you. In the meantime, take care out there, and I hope that you'll join me again next week. Bye now.